Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about inventory and a lot about inventory. It's been so much fun. We've talked about the importance of inventory. We've talked about lower of cost or market adjustments. We've done basket purchases, and we started talking about how we estimate ending inventory without having to do a physical count. We did the easier of the two methods, the shortcut method, the most common method, the simpler method, whatever you want to call it. We call it the gross profit method last time. Now we get to talk about the more involved, but also more accurate retail inventory method. And as we get into this, very first thing I want to mention is that you can use this number for anything, including those annual financial statements. The flip side of that, because we allow it to be in the financial statements, it requires much more work. It also requires a much better set of information. And here's the list of that information. First, you have to know the beginning value of your inventory at cost and at market. This is not just kind of a general estimate. This is every item you own at the beginning of the period, what it cost and what I could have sold it for. And then I have to know the same numbers for my net purchases. So I need to know what it cost me for my original purchases, what I could have sold them for, if I gotten a discount, what that would have done to my sales prices, if I returned some, what that would have done to my sales ability, etc. So a lot more information needed there. A lot of times with a good computer system and a database, you can pull it out awfully fast, but it's this huge amount of data. I've got to know all of these things for all of my different pieces of inventory that stop people from using this retail inventory method. The only benefit is the fact that if I do this, I just get the accounting department involved and working hard and coming up with all these numbers. I don't have the entire staff counting inventory through the warehouse. A lot of information, but some benefit as far as who's involved and how much it costs to make it. Two other things, I need to know my sales during the period, and I need to know any markups or markdowns that I've made during the period. Markup is really easy. If you've ever tried to buy an airline ticket right before a major holiday, Christmas, 4th of July, Mother's Day, maybe not Father's Day, but Mother's Day definitely. When a lot of people want to travel, you've noticed that those airline tickets go up. If you want to buy steaks or barbecue sauce at the 4th of July, prices have gone up a little bit because people know you'll pay at that time. That's a markup. Markdown, that's what happens after a holiday, when they've got all the extra charcoal lying around or they've got all the old decorations just laying there. We drop the value to try to get people to buy it. It's a sale. Mark up, price goes up. Mark down, price goes down. Doesn't get any easier than that, except once again, you need to know all the markups and all the markdowns that you've done all year long for all of your inventory, or all period long. So again, a lot more information. This would be impossible to do without database software. But if you've got it and can pull these numbers, it can be a very powerful method, especially once you've set it up and can get the numbers to come out pretty much automatically. Once we know all of this information, or know that we can get it, then the next thing we need to decide on is what version of the retail inventory method are we going to use? Are we going to use average cost? Are we going to use the lower of cost or market or conventional method? Are we going to use Fifo or LIFO? And the nice thing about retail inventory versus gross profit is it allows us to be flexible and do all of the different methods. Let's go ahead then and jump into how we actually do this. Step number one is to figure out ending inventory at retail. So at the end of the period, what could I sell all of this stuff for that's still in my shop or my warehouse or whatever? Second, we need to create a cost to retail ratio, and it's based on whichever inventory flow method you decided on. So if you want to use your average cost method, then you take the cost of goods available for sale and you divide by goods available for sale at retail. And we'll see those numbers here in a minute. If you want to use lower of cost or market, my ratio will be cost of goods available for sale divided by goods available for sale at retail after the markups. If I want to do FIFO, I throw out the beginning inventory numbers because I assume under FIFO that I've sold off all of my beginning inventory. So it shouldn't be part of my ending inventory numbers at all. So we'll get them out of the equation and then we'll do a ratio. LIFO is the most exciting because under LIFO, I assume my beginning inventory is there. So I'm only adding on a new layer if it's grown. If it hasn't grown, then I'm only looking at those beginning inventory numbers because that's all that's left. That's a lot of detail. You kind of need to see it in action to really feel comfortable with this. Next, step 3, we're going to compute ending inventory. And ending inventory, again, has a couple of options, and you can see a lot of detail down here. Basically, for average cost, lower of cost or market, or conventional, and FIFO, it's all the same. We take the ending inventory number at retail, which we got from step 1, we multiply the ratio from step 2, and that's our number. If it's LIFO, there's a couple of steps. We either add a layer, we take away layers, and it changes our method whether or not we're adding a layer or not. Finally, if we need not just ending inventory but cost of goods sold, once we have an ending inventory number, we can calculate that cost of goods sold number. There's a lot going on here. The steps will make a lot more sense as we do them, so don't get bogged down here. But this is a key concept, understanding how to do retail inventory method and knowing that the real difference between inventory flow styles is just the ratio that we choose. That's our key concept for this method. So let's start out with our example. Again, we've got our SHDW incorporated. They've gathered a lot of information, but they don't have an ending inventory number, and they've asked us to figure it out for them using all 4 of the inventory flow methods: average cost, lower of cost or market, FIFO, LIFO. And they were able to dig into their database, and they have pulled for us all sorts of numbers. Now, please note this 115,000 here for cost and the 179.4. Remember, that's not just here's my one inventory item, here's what it cost me. This is it cost me 115,000 for everything I had in my shop at the beginning of the period. And I could have sold all of that stuff for 179,400 at what I was charging at the beginning of the period. And that's how all of these numbers are. It's a conglomerate of everything in our shop or our warehouse or our production facility, etc. So please write down these numbers or print them off or have them there so that we don't have to keep jumping back and forth. Let's go ahead and go through the steps of the retail inventory method. First thing we need is a table. Description. Then we're going to need some cost information. Give myself plenty of room here. And then some retail information. Remember, retail is just what I could have sold it for. So let's start with our beginning inventory. And my cost of my beginning inventory was 115, and the retail was 179,400. Now again, we've mentioned this before, but I'll mention it one more time. All of these numbers, I've given them to you. They're in the previous slide, but they would come from your database. You would pull all of this information from your either your accounting database or your inventory database or your ERP system, whatever your company uses. You'd pull it out. I had this many units with this cost, and this many units at this cost, and this many units at that cost. Okay, well, here's my cost amount. So that's what we're doing. One number summarizing everything in my inventory, and I'm getting it from a database system. All right, I'm getting off my horse. I just want to make sure you're comfortable with that. Next, I need my net purchases. And net purchases will start with actual purchase values, so original purchase values. So my cost, again, coming from the table on the other slide, $998,500. Retail value at what I'm charging would be $1,737,390. I had some purchase discounts. $23,268 is the cost. $40,486 would be over here to retail. We don't have any of these, but just so you see where they go, if you had any purchase returns or allowances, they would go in here too. We'll put them as a negative. Zero is not really a negative, but we'll put it in like that. The last is shipping, often referred to as freight in. And the rule with freight, I add it in cost, but I do not add it in retail. So highlight it, circle it, mark it. Shipping cost is for cost only. There's no retail equivalent. And that allows me to calculate a net purchase amount. So $998,500 minus the $23,268 plus that $10,000 gives me $985,232. And over here, I take the 1,737,390 minus the 40,486, and I get 1,696,904. And now that I've got net purchases and beginning inventory, I can get cost of goods available for sale for my costs. Take the 115 plus this 985, and I get 1,100,232. And that's cost of goods available for sale. Over here with retail, I'm going to do the same thing. I'm going to add this up, and I end up with 1,876,304. And I wish I could tell you it had a cool name. It doesn't. I just call it a subtotal, because it actually doesn't mean anything yet. There's more I need to add for the retail numbers to make sense. Now, for the cost side, I'm done. I get to cost of goods available for sale, and I'm finished. Retail, like we said, we need to add some more numbers before it gives us anything of worth. So we're going to start by adding our net markups. If I had done nothing different during the period, I only charged a set amount, I never changed it, I always charge that amount, then this would be what we call goods available for sale at retail. And I could use that number and move forward with my ratios. But I do add things. So markups, remember, are when companies raise their prices. And I had markups this period of 350,000. And then I had what we call markup cancellations. And that's where I tried to raise the price and people wouldn't pay it, so I ended up canceling them out. So my net markups, if I take 350 minus 175, I get a positive 175,000, and I'm going to call that goods available for sale at retail after markups. So that's the 1,876,304 plus the 175. That's going to give me $2,051,304. Next, I'm going to take out my markdowns. So less net markdowns. And that's going to work the same way. I'll take any markdowns that I had. These are the sales I offered from these original prices up here. And I had markdowns of 240. And I don't have any, but I can also have markdown cancellations. Where I had the sale and realized people were still paying what I wanted, so I could cancel the sale and still get my money. So let's see, 2,051,304 minus 240 gives me 1,811,304. And this is my goods available for sale at retail. Make a note, highlight it, circle it. This is the retail equivalent of cost of goods available for sale. Now I'm not done yet. I need to make one more calculation, and that is I'm going to subtract out net sales. This is going to be sales minus discounts minus returns. And one thing we don't normally think about when we think about discount, if I offer employee discounts as a perk to working there, that's not considered a markdown because it's not a sale to my customers. It's a benefit I give to my employees. So I keep it out of markdowns up here, and instead I put it down as part of net sales down there. We weren't told about any employee discounts in this case. We don't have a discount or return number. All we know is we were told our net sales was $1,560,000. And that lets us get our ending inventory at retail. So 1,811,304 minus 1,560,000 is 251,304. And that number right there, that's step one. And I usually get a bunch of people laughing at me at this point. Really? That's step one? Yeah, that's step one. The nice thing about it is whether you use average cost, lower cost or market, LIFO, FIFO, this is the same. no matter what. And when we come back in our next segment, we'll talk about what we do now that we've got this table. We'll see you then. Thanks.